All right, so class 26, we're going to finish up what we were working on last class, which is relative value analysis. I promised you I would show you a model in Excel for how you could actually use relative value analysis to come up with a stock portfolio or for a buy list for stocks. And that will feed in really well to the next topic, which is creating an actual portfolio. So let me show you the Excel file from last time. I mentioned last time. All right, so this is a model that is for consumer staples. I've got 79 companies here. There's their tickers, there's their names, the different subcategories they're in, but all consumer staples. And then I brought in a lot of data. Some data is related to turnover, sales growth, net working capital requirements. Other data is related to margins. Some data is related to return on capital. And then there's data related to risk. So I brought all this data in for these 79 companies, and then I want to rank them. So if you look at Molson Coors, they rank number 1 on sales growth. You look at sales growth, their sales growth was 53.35%, so they're number 1. But Alico has sales growth of -17, so they're the last place company. And that's our ranking. The way we do ranking is use the rank function in Excel. Equal rank, you take the number for Archer Daniels Midland, and you compare that, a rank against all 79 companies, and then we use comma 0. There's a 0 up here. What comma 0 tells you is highest numbers should be ranked number 1. So Molson had the highest numbers, so they're ranked number 1. The lowest numbers should be ranked last place, 79th. So Alico had the lowest numbers, so that's where they rank. You can see Alico does really badly on just about everything except for capital management. They manage their capital management well. So, and you have some things like related to risk, the probability of default. You notice here we're using comma 1, and that's because a firm that has a high probability of default should be ranked lower than a firm that has a low probability. So Tootsie Roll has the lowest probability of default, kind of an interesting company. So you look at probability of default, it's only 0.04%. That's amazing, that firm. I don't know much about that firm, but for some reason their default probability is really, really low. So we rank them all the way through, and so we've got 15 items to rank them against. So here's 4 risk numbers, 3 related to return on capital, 4 items related to margin, and the rest related to turnover and sales growth. So there's 15. So what I want to do is take 1/15, which is 6.67%, and I just want to put that into each one of these things that we have. And when we do that, you can see that they add up to 100% because this sums them all. And we also have 2 relative value. So I'm going to put 50% in them, and they add up to 100% as well. So I use 2 relative value factors. One is EV to EBITDA. We talked about that one last class. And then EV to sales. So what I'm doing to start with is I'm just putting equal weight over all of them. And then what I'm going to do is, here's my model, and here's the market. I want to compare where I rank a company versus where it's ranked. So on the EV to EBITDA, it's comma 0. A rank, comma 0, and the reason for that is the highest EV to EBITDA should be ranked number 1 as the most expensive company, and the lowest be the cheapest. And what I'm figuring out is if the rank on my model matches up with the rank on the model. Is my number 1 company, let's see if we can find my number 1 company. Is my number 1 company also the most expensive? So we see here Monster, for some reason this model has always liked Monster. Monster rank is ranked number 1. It's the 4th most expensive, so it's pretty close. The problem with this model, though, is it has an R-squared of 14%, which means all the factors I brought in only explain 14% of the variability and relative values. So I wonder if I can get that higher. So right now I've got equal weight all the way across. My fundamental and risk factors add up to 100%, and my relative values add up to 100%. So what I'm going to do, I'll come back and explain what I just changed there a little bit later, but what we're going to do is we're going to actually go to Data, Solver, and what we want to do is we want to maximize this correlation. Remember, R squared is just the correlation squared, so we want to maximize that, so we maximize the R squared by changing all of these weights, the 50 and 50% and the 6.67%, change all of those and change those weights in order to give me the highest correlation possible. Making sure that the sum of the weights equals 100%. I have 4 other constraints I'll talk about here in a second, but those are my constraints. And so I'm going to say, okay, run solver, change all these allocations so that you give me the best R squared you can possibly give me. And you'll notice as it's running, the value's going up. So we got up to a correlation of 0.88, which gives me an R squared of 78%. And if you look at that, you can see where it allocated. Some things they didn't put any weight on at all. Put a huge rate on gross margin, which makes sense. Put a huge rate on growth in sales. A huge rate on margin again. So a lot of weights on margin. A big rate on the probability of default, which makes sense. And then on the valuation tools, it put all of its weight on EV to sales, which is exactly what we expected. With retail stocks, just like we talked about in class, retail stocks, you want to use EV to sales, so our model confirms that. Now, do we like this model? What this model is telling you is what weights should you put on each one of these so you get a model that most closely approximates what the stock market thinks. But remember on the real estate example, you had the person, someone was killed in the house and it was haunted, and that was influencing value. But you might say, no, that's not important to me. I don't want a model that just tells me what the market thinks. I want it to reflect what I think. So you come over here. Remember, we have items related to turnover, to margins, to return on capital and risk. And I've got some minimums here. I'm going to say I want to have at least 10% in turnover, probably at least 40% in margins. That is the most important. Give me at least 20% in return on capital and at least 20% on risk. So I'm going to put those constraints in here. I'm going to come back and I'm going to do Data Solver, and that's where you see those 4 constraints. Make sure you're at least greater than or equal to those minimums. And now we'll solve. I always see the R squared is going to come down because I'm constraining the model. We saw that early in the semester. You might not remember when we were doing style analysis in R squared. So you see our R squared went from 78% to 70, but that's still pretty good. And so I've got a really pretty decent model here that's telling me about these stocks. So you can look at Brown-Forman. Our model ranks at 7th, but the market actually has it the most expensive. Constellation Brands, boy, it really loves alcohol, doesn't it? So Constellation Brands, we ranked at 10th, is actually number 4. Our model loves Procter & Gamble. It is expensive, but not as expensive as our model, so there's an opportunity. Colgate. We actually bought Procter & Gamble based on this model. We did not buy Colgate. WD-40, not all that particularly exciting of a firm, but our model liked it, but it looks like it's perfectly placed, perfectly ranked. Hershey's is a firm we actually bought. It was ranked 6th on our model. It was 13th overall, so it looked a little cheap to us. Here's a terrible looking firm, Freshpet. We ranked at 48th, so in the bottom half, and yet it was the 2nd most expensive. Now, Freshpet, it could be one of those home delivery of pet foods. If that's the case, yeah, I mean, there's some excitement there, but their numbers probably look really bad because they're just getting up and running and probably losing money. I don't know if that's what that firm is, but it could have been a good investment, but our model's kicking it out, so we won't look at it. And that's the problem with using these type of computer screening. There may be a great opportunity, but because you don't have time to look at 80 companies in detail, you have to have a list of 5 to 10 so you can get into it. It's going to kick out some possible good opportunities. Estee Lauder, our model didn't like it nearly as much as the stock market does. We did buy Pepsi. You can see our model liked Pepsi, but much more than the market. Monster, again, is ranked number 1. It was the 3rd most expensive, so it doesn't look like a great opportunity. It looks like it's well valued. So that's what we're looking at, and then we can graph all of this. And when we graph all of this, so if you look down here, Here's a firm we ranked 7th, but it was the most expensive. I think that's Brown-Forman. Not terrible, but a little expensive. And yet here's a stock that we ranked 4th, but it was the 19th most expensive. So we like the stocks. Our buy list is probably going to be this stock right here. What we said is we want stocks that our model ranked in the top half. So make sure they're ranking our models at least 40%. So you put a line there. And then we want to be as far from the line as possible, because the farther north you are from this gold line, the cheaper the stock is. So that's why I say this group right here would probably be, I don't know if I can put it won't let me add oh, maybe it will. Let's see. Let's try it. So, no, I can't get it, but those right there would probably be good. These two would probably be good. And these three would probably be good. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9. They rank in the top 40%, and they look cheap because they're far from the line. So that gives us a good buy list of stocks that we could look at. There are some really bad looking stocks, like we ranked it 77th, but it's in the top half in valuation. That might be a stock we put as a short candidate that we'll actually sell. So there's our model. You bring in all this data. So I'd really if you've never done something like this before, I'd really recommend you can join the investment society and join a sector team. Hopefully we'll be back on campus in the spring. I'm planning on doing a sector team in the spring, even if we're not back on campus, just so we can make sure we don't lose these skills. Or you can get our many YouTube videos that show you how to do this, and just watch a YouTube video and build your own model yourself on your own time. I've had students able to do that all on their own. Even non-finance majors have been able to do it. So yeah, it's just bringing in the data. You define what's important to you, but the first thing you run is the highest R-squared you can, so you can see what is the market telling you, what do they think is important, and then you adjust that for what you think is important. And that's somewhat what we did. We could actually go back and still change these weights if we wanted to. We say, okay, there's no debt to equity, so I'm gonna add 5% here and take that out of here. Oops, yeah, that worked. So I still add up to 100%. My R-squared dropped quite a bit, so I don't like that, so I'll take that out. But you can still change the weights, but you know, anytime you change the weights, your R-squared has to be the same or go down, because as you constrain the model more, it's definitely going to impact your results. So let's talk. So you essentially get a buy list. So we're picking those stocks that were in our top 40%, but they're at least ranked 5 to 10 better in our model than what the market had them ranked. So that gives us a list of stocks, and we could take those stocks and just buy them all. They could be actually our buy list. So I think it was 8 to 10 stocks we had there. Or they could be on our short list, and we're going to pick 4 or 5 from there to buy. So we're going to try to create a portfolio. So how do we do that? So I'm going to go to page 47 of the notes. The first question is, how much money do you need to start a portfolio? So if you have $4,000, $5,000, you're going to be buying mutual funds and ETFs. It's unlikely you're going to be putting your money in the individual stocks. I mean, you could, but you're going to be really limited to do that. There's some stocks trading for $1,000. So if you only have $4,000, you'd have to put 25% of your portfolio in that one stock, because you can't buy fractional shares. If you have over $100,000, I say 150 here, but even 100,000 or even 50 is getting a little bit low. You can create your own stock portfolio. It depends on how many shares, how many stocks you want, different stocks you want in your portfolio. But you'll probably, if you get too far below 100,000, you'll probably be buying mutual funds or exchange traded funds, like we talked about earlier in this semester. Now, if you're doing bonds, you can have a small portfolio of stocks, but bonds are an institutional investor market. It's for large investors. When I was at UTSA, they were trading in blocks of 50 to 100 million. If you don't have $50 million or more, and even 50 is getting close to have a portfolio, because you don't want to buy one bond, so you want to have a group of bonds. So you're putting $1 to $2 million in each bond. It's just they're very small lots. LOTS, a small lot, that means you're a small trader. You're not doing round lots. You're not buying 100 issues or 100 shares. You're going to pay a hefty fee to do that. So you generally have to have a fairly large portfolio. Most individuals will buy bond mutual funds, or bond exchange traded funds, or bank or life insurance product. Now, the way I think about these, and I always compare the three of them anytime I'm making a decision. So bond mutual funds, they always give you the market rate. Whatever current rates are, that's what a bond mutual fund is going to tell you. So I like to compare those to bank and life insurance products. Several years ago, banks were paying ridiculously high CD rates, certificates of deposit rates. I remember I was on the board of a credit union, and their auto loan rates were 5%, but they had CD rates at 7% for the same term. So they were charging their customers 5, and they're paying their customers 7. It's like, how do you make money on that? I went to the president of this credit union and said, why do we have rates where we're paying our customers more than we're receiving on loans? We actually have a negative spread. And his argument was, well, no one's buying those CDs. And I told him, well, I'm buying one. So I'll put money in that CD, and that was a great CD, a 7% CD. Can you imagine? With full faith and credit coverage by the U.S. government, that's a pretty good investment. So banks do pay really good rates every once in a while. Life insurance companies, they have deferred annuities. Back in 2008, the life insurance company I worked with, they had ridiculously high rates on their EGAs, which is a deferred annuity. They were paying guaranteed for 10 years 6%. I thought, guaranteed 10 years 6% in the middle of a financial crisis. Treasuries are dropping fast at 1 or 2%. Yeah, 6% guaranteed for 10 years plus tax deferred, so I don't even have to pay any tax on it. That sounds great. Also, at the end of the 10 years, there's a guaranteed minimum return of 3%. So the worst case was, after 10 years, I'd be making at least 3. And 3% now, the 10 years is over, but the 3% looks like a ridiculously good rate still for almost something that's practically no risk. Paying 3% when treasuries are paying 0.6%. It looks like a really great investment for a portion of my fixed income portfolio. Now, why would a life insurance company pay rates like that? And life insurance companies, especially at the end of the year, they have sales goals, and they want to meet those sales goals. They're willing to actually lose some money if they can hit their sales goals, and that's exactly what this insurance company was doing. They were pushing high rates so they could sell a few more products and make their goals, and I took advantage of it. The actuaries there knew me really well, and they heard I was buying their annuities. They said, oh, okay, we're definitely paying too high if Ron's buying our annuities, because they knew I was a very picky purchaser of fixed income securities. And if I was buying their securities, then yeah, I was probably seeing something. Mutual funds right now are probably the best bet. Bank CD rates are still ridiculously low. Life insurance annuities have been very low. But you have to watch every once in a while. I usually compare all three, and just every once in a while, every year or two, just see what's going on. See if it makes sense for me to move money from one to the other. Now, the other thing you have to be careful with, if a small investors will generally buying treasuries is no big deal. You could probably buy treasuries. There's something called Treasury Direct, DIRECT, Treasury Direct. I can't remember if it's .com or .gov, but you'd be able to find it. I bought one treasury on that site once for $5,000. I did it just to see how the process worked. I wasn't really interested in treasuries. My boss at the time, or the portfolio manager at the time, got really mad at me. He said, we don't buy treasuries at USAA. Their yield's not good enough. I was like, I wasn't buying it as an investment. I wanted to see how the process goes through, where you bid on the treasury and see what final yield you get. So I thought it was interesting. But treasuries are very liquid, and you can buy those yourself very easily, not that difficult to do. But beyond treasuries, it's really dangerous for small investors to buy bonds. A lot of them do buy municipal bonds. Remember, we talked about municipal bonds being tax-free, and there are a lot of small investors that will buy these things. But oh, I remember stories at USA where the portfolio managers at USA would just get so irately mad. They would sell a municipal bond for, say, at 92 because that was the right price, because interest rates have risen some, and so they were trading at 92. And they would see the person they sold it to break that up into pieces and sell it to their customers at 100, which means their customers immediately had a 9% loss. They should have gotten something at 92 and had to pay 100. And boy, it made USA so mad, because if these customers had just come and bought USA's mutual funds, yeah, they would have paid a management fee of 0.4% a year, but they wouldn't have lost 9% on the very first trade. So it's a frustrating business. The people doing this are not always really looking out for their clients, because many of them know their client would be better off with a mutual fund. They're just trying to get rid of their book of business. And think about that broker or whoever that was that bought that municipal, bought it at 92 and turned around and sold it for 100. It was a lot of work. He had to get it spread out to all of his customers and break it up into pieces. But boy, that's a lot of value in one day, breaking that thing up. So be careful. I really think on bonds, you're better off buying mutual funds or ETFs, and then looking at bank and life insurance rates just to make sure they're not paying ridiculously high rates. Now, when picking stocks, there's two questions, and this is a question I always ask in interviews. I don't do interviews much anymore, but when I was interviewing people for jobs in finance, these are the two questions. What is a good company, and what is a good stock? And unfortunately, when I interviewed undergraduate students, it didn't seem to matter what school they went to. I almost never got good answers to that question. So from undergraduate students. Now, from people who had experience, I remember interviewing analysts who had 10, 15, 20 years of experience. I'd ask that question, and boy, they'd go over to their briefcase and they would pull out a stack of paper, and they loved that question. We could spend the whole rest of the day just talking about that question. So a good company is one who has good fundamentals. Their ratios look good. They have good growth. They have stable growth of earnings and cash flow, and they have stable earnings. Their risk is low. They don't have a lot of debt. They have low betas. They have stable earnings, high quality management. That's a good company. What's a good stock? A good stock is one that's you can buy it for less than what the company's worth. A good stock is one where you can buy it for $50 and it's worth $80. That's a good stock. So a good stock has to do with valuation. Using a dividend discount model or a relative value model, like we talked about last class, the last few classes actually. A good stock is one that looks cheap versus others. There are good companies that are good stock, but it's stocks, but they're really rare. Usually if it's a good company, the stock is going to be expensive. There are bad companies that are bad stocks. So it's a terrible company, but the market still has it overvalued. I think that was true for GM not too long ago when GM went insolvent. Its stock still had a price, like $1 or $1.50, and people were buying and selling it. Well, it was worth zero. We knew it was worth zero because the firm was insolvent. There is no way the bondholders were going to let the stockholders get any value out of that firm. But it was still trading around, and people were trading. Well, that was a bad company whose stock was a bad stock as well. There are many good companies that are bad stocks. They're really great companies. All the numbers look great, but they're real expensive. Amazon might be in that category. I get a little worried about Amazon just because its retail section is not making that much money. Everything's coming from AWS on the cloud computing. So is the market overvaluing the retail side of Amazon? Some might say Tesla. I'm not sure Tesla is a good company from the fundamentals. They might be getting that place because they have high growth, but their profitability is still pretty weak, and they're a very volatile firm. But definitely an expensive stock, very expensive stock. And then you have bad companies that are good stocks. Maybe a Macy's. Macy's is priced to go out of business, but if you think they're going to have a tough time of it, but they're not going to go out of business, there'll be some remnant of that company around. So if it's priced to go down to zero and you think it might only drop they may close only 50% of their stores, there's still something there. Or maybe they get sold out to another store, maybe they merge with a Nordstrom's or someone. Then maybe you buy it. The numbers look bad, but the stock is so cheap. I like what Warren Buffett says, or no, it might be, might not be Warren, I can't remember who said it, but that there are no bad assets, only bad prices. So, yeah, so a bad asset is one who has bad numbers, bad fundamentals, but if it's cheap enough, you still buy it. So loaning money to Puerto Rico, obviously that area has, that territory, the U.S. has had a really tough time with the hurricane and heavy debt. So you look at that and say, well, there's no way the government will pay off the debt. Maybe you only get 20 cents on the dollar. Well, if the bonds are priced at 10 cents on the dollar, yeah, the government's going to pay something. It's not going to go to zero, so you buy it at 10 cents on the dollar, and you end up getting 20 cents of your money back. That's a 100% return. The only question is, how much time does it take to get the money back? Same thing with Argentina debt, or other countries that are really struggling, South Africa maybe, that are going through somewhat of a turmoil, and you just have to ask, is there a price where this asset makes sense? So good company, good stock, and you need to have some kind of process to do that. So here's the process I want you to think about, or this is the procedure, or just the thought process to go through. So you need a philosophy, you need a process, you need some way to do a portfolio construction, and then you need risk management. So let's go through those. The first thing you need is a philosophy. Your philosophy will say something along the lines, I believe, or we believe, stocks with these characteristics will beat the market. Now, what could that be? So you need to be thinking about this. You really need to develop something like this before you start seriously interviewing for jobs, especially if you're interviewing on the investment side of finance. So you need to have a statement. If you don't have one, go steal somebody's. There's some great websites out there, gmo.com. I'm going to show you a few today. You can go out and just steal theirs, their ideas, make it your own, reword it into your own words. And you might not fully believe in it because you haven't really tested it yet, but it sounds good, sounds like it could work. So I'll give you a few examples here, but yeah, have your own theory. And when they interview you, they're not trying to see if they agree with you. They're not expecting an undergraduate student to have the next perfect Renaissance-like model that makes billions of dollars. What they want to know is that you're curious, you're into this, you enjoy finance so much that you're doing this in your spare time. So how could you state a philosophy? It could be based on fundamentals. This is the good stock idea. I want good quality companies. So fundamentals and quality kind of go together. Good growth, good earnings, good return on capital, high quality management. High quality management's a little bit hard to screen on because it's very subjective, but there are ways you can try to figure that out. Quality could be their credit ratings, how much accruals impact their numbers, again, good management. You might team that with valuation. So you don't want to overpay. So a real popular strategy that I encourage students, if you can't think of one, just go with this one because it's an easy one. It's called GARP, G-A-R-P. So it's growth at a reasonable price. What that means is you want good fundamentals. You want firms that are growing. You know they're going to look more expensive than horrible companies, but you want a reasonable price. So you expect great companies to be a little more expensive than other companies, but you don't want to overpay for it. That's GARP, growth at a reasonable price. So you're looking at fundamentals, looking at quality, and then you realize on valuation, the stocks you're buying are probably going to be a little more expensive than average, but that's because you think the fundamentals are much better than average. If you don't like it all that, you can do technicals. If you can do technicals, there's a lot of them. The most popular is momentum, moving averages, really simple. A stock whose price today is higher than it was 6 months ago is probably going to, on average, will outperform a stock whose price today is lower than it was 6 months ago. There's just once stocks start going up, they tend to keep going up for quite some time. So that's simple moving average. Very simple way. It really is simple. If you do a 200-day moving average, you just get the average of the stock price the last 200 days. and you see where it's trading relative to that 200-day moving average. Is it above it or below it? So stocks with momentums will be above their moving average. So if the average of the last 200 days was 50 bucks and this stock's trading for 53, it's above its moving average. It has positive momentum. So that's technical. There's a lot of other technicals out there. There's plenty of websites, sites, and books that are really good for technicals that if you want to learn that side. You could be a thematic investor. A thematic investor, they have some economic outlook, something that they think is just going to work well. That's kind of general and global. We used to do that in Investment Society. We stopped doing it a few years ago, but at first we had these themes. Two of our themes were U.S. baby boomers. We thought, okay, baby boomers are retiring. They're moving. They're going to downsize. Some of them are going to go into nursing homes or into senior living. So we try to find some things there like storage facilities, like senior living, real estate investment trusts, those kind of things. Some of them worked out, some of them didn't work out so well. Another theme we had was the China consumer. Who are those companies that will benefit when the Chinese consumers start spending? Right now they're not. They're saving because they don't have good insurance platforms yet, but that's starting to develop. And you got, this firm Ant that's in China, they got shut down on their initial public offering, but still a firm that's really helping the Chinese get access to insurance and banking and credit. That might help the Chinese stop saving so much and start spending more. Well, what firms will benefit if that happens? So those were our themes. Or you could just be a stock picker. And you want to kind of say, are you a thematic investor, so you set the theme first? Are you a stock picker? A stock picker starts with the Excel, just like I showed you, takes the whole universe and just tries to find the best stocks in there. It's just stock pickers. Just give me good stocks, and I'll buy them. Whatever your strategy is, you need to state it clearly. And once you state it clearly, then you might want to go back and back test it and see if your philosophy actually works. One strategy I really like, but I haven't had time to test it. But Cliff Asness, he has a philosophy that historically small cap value stocks. Remember we talked about small cap earlier, and we talked about value stocks. Small cap value stocks has been really the best performing asset class over the longest time. That probably has gotten behind here recently with growth stocks doing so well. But over the long term, it has given really good returns with much less risk than you would expect given the returns. But Cliff Asness says the small cap value outperformance has really disappeared the last couple of years. But he said if you adjust for quality, that excess return from small cap value is still there. So what does that mean? Well, think about how simple this is. And that's when we get to this second thing, is the process. How do you actually find the stocks that meet your philosophy? So you might say, I want small company stocks because they're not well followed, they're not well discovered. They're the next big winners like the Microsofts. We want to buy them early. If they're not well known, we have more chance for that tremendous upside with limited downside. We want value stocks because we don't want to overpay for these stocks. However, value stocks are low quality, so we want high quality small cap value stocks. So now what is your process? Well, the process might be take the Russell 3000 and sort out all the value stocks. So there's about 1,500 of them. Russell does a little strange where a firm can be 60% value and 40% growth. But sort them out so you have all the predominantly value stocks, and then rank them on quality. So maybe use the probability of default from Bloomberg and rank them. And those that have the lowest probability of default go on your list, and you might try to make sure you get at least a few small cap in each sector. So you don't have a 0% allocation. So you might say, and this gets into portfolio construction, so I'm getting ahead, but that's how you do it. You get your screening is to give me all the small caps value stocks, and then I'm going to screen out the low quality ones, and what I have left, those are the stocks I can put into my portfolio. So that's the process. If you talked about that in an interview, you might have to give Cliff Asness some credit for that because the person you're interviewing with might have heard it. But if they hadn't and you just mention his name, you won't be in any trouble then. If you say, yeah, I was reading about a strategy a hedge fund manager Cliff Asness has, and I found it interesting. So I thought I would expand on that and then give the strategy. Then, in case they do know Cliff Asness, you're not in trouble for plagiarizing his idea. 90% of them won't know who he is, so you won't get hurt at all by that. But yeah, still somebody else's idea, and just try it. But I did say, it is good to try to backtest it. Backtesting is really, really tough. So let's say we did our strategy. Let's go back 10 years, and we bring in all the small cap value companies, and we sort them out by quality. That sounds pretty easy, and then see how they would have done the next 10 years. The problem with that, there's a couple flaws. First of all, if you're looking at probability of default, you want to look at their probability of default 10 years ago when you're testing, not what their probability is today. So that's really hard data to get. You'd have to somehow find ratios that would tell you, you'd have to kind of back into that ratio. You probably could. Bloomberg does share all that information. You probably could replicate their model. But the second problem is what we call survivorship bias, and I'd recommend you Google that and read about it. Survivorship bias is when you're testing a strategy and you go back, the only companies you can look at are those that are still in business today. So if you had a firm 10 years ago that went out of business 2 years later, it would not be in your database. And so if you're going back and testing your philosophy, you're starting with a database that's pretty clean. All the firms that went insolvent are out of your database. So if you're comparing that to how the market actually performed, the market itself had those firms that went insolvent in it. And so you have survivorship bias, which can add a lot. You might test it historically and say, wow, this really works well, but it's not really working well. It's only working well because firms that you might have bought that would have gone out of business, you can't buy because they're not in the database anymore. So, that's an issue. It's really hard to correct for. But read about it. You can hear, one of the reasons I hired a few hedge funds in my career, and some of them had back-tested data, and the back-tested data always look great, or else they wouldn't show it to you. But you have to question, can they really replicate that going forward? The best way to build back-test is to just start your strategy. So I need to do this with a small cap value and try this strategy. Just start today and then start collecting those returns over time. So pretend like you're executing the strategy today, execute it today, start collecting the data, see how your returns are, and after 3 or 4 years, you'll have some good data, and then you'll have more confidence. And then you don't have the survivorship bias because you're starting your back test today with today's data. And that's what hedge funds do. They have what they call incubators, where they have a strategy they like, and they may run that strategy themselves without any investor money and test it over 3 or 4 years and see how it works before they take it out to their clients. All right, so there's the process. The next part is construction. So you have your philosophy, you have your process. Your process tells you what stocks you want to buy. So now the question is, how do you put those stocks in the portfolio? The easiest is equal weight. If you have 50 stocks on your short list, and those are the ones you want to buy, then just put 2% in each one of them. You got your portfolio. That's equal weighted. There's a lot of research studies that show that equal weight has done well. My guess is it probably has not done well recently. And the reason for that is, if you really think about equal weighted portfolios, they tend to give you a skew toward value companies, value stocks, and towards small cap. Because if you think about it, Apple is a growth company and it's large. If you do equal weight and Apple's 5% of the portfolio, 5% of the market, but you only put 2% in each stock, and Apple's 5%, you only put 2% in Apple, you're underweighting this large growth company. And then you got this small company that's 0.3% of the portfolio, and you want to buy it, so you put, and it's a value stock because you bought it because it's cheap. So you got 0.3, and it's cheap because it's a value stock, and it's a value stock because it's cheap. So its weight's only 0.3, but you put 2% in it. Now you're overweighting the smaller company, and it's smaller because it's a value company, so its stock prices come down. So it tends to skew you toward value and small cap. And that's been the biggest complaint. Robert Arnott, he doesn't do equal weighted. He does what he calls fundamental weighting, where he weights the stock in a portfolio based on some fundamentals like revenue or net income or net worth. I encourage you on this one. This is a great one to look up. Look up smart beta, In fact, best thing to do is do smart beta and R naught, and smart beta and ASNES. ASNES is ASNESS. Those two have been having a debate in public about smart beta. It's an interesting strategy. I actually call it smart alpha instead of smart beta. I'm kind of with Cliff Asness that it's more alpha than beta, but you can definitely read up on it. It'd be a really great thing to read up before you go into an interview for an investment job, because they'd be impressed that you're keeping track of the latest fads, and we'll see if this is a fad or not. Arnott is one of my favorite people in finance and in investing. I read everything he writes. Really sharp guy. So if he's doing it, that gives me some sense that there's probably something there. But Cliff Asness I also really like a lot. He's a really sharp guy, and he's a critic of smart beta. And for that very point, he says smart beta is really nothing more than value small cap investing, which, you know, it's a perfectly good thing to do. You can do a market-weighted portfolio. So if Apple's 5% of the market, then you want to give Apple a big weight in your portfolio. You can't give them 5% because you're not buying every stock. But if Apple is twice as big as NVIDIA, then you put twice as much in Apple as you do in NVIDIA. Or there's portfolios called enhanced indexing. In enhanced indexing, what they do is they look at the weight of the stock in the market and then make sure they're within plus or minus 0.25% of that weight. So if Apple's 5% of the market, then you must have at least 4.75% in Apple and no more than 5.25% in Apple. So it's kind of like an index fund where you're trying to just add a little bit of alpha over the return of the market. Alpha is your excess return, how much return you have over the stock market. You're just trying to add a little bit. I invested in a few enhanced indexing funds in my time. In fact, one of the managers we use invited me to speak at a conference to try to give the story for enhanced indexing. So that was kind of fun and cool. I had a pretty hilarious chart at the end where when you put all these sales pitches together, you end up with a portfolio that's really too good to be true. You can do your weights, your construction based on your model. Your model might tell you. You might score stocks. One thing I like, JP Morgan had a model where they have a lot of analysts at JP Morgan in all different industries, all different sectors. And so JP Morgan takes what those analysts, they do all the stocks they're following on the sell side, and they put them in quintiles, our top quintile, or next, second, third, fourth, and fifth. And what JP Morgan would do with this product is it would pick all the stocks it's going to buy out of the first two quintiles, maybe the third one if they need to fill in a sector, and they avoid the bottom four because they could show historically the stocks that their analysts ranked in the top quintile and the second quintile outperformed the market. So if they just buy their stocks from that list, they should over time outperform the market. So that's kind of a scoring model. And then there are firms, especially hedge funds, that do optimization models. What they do is they give a return and risk and correlation for all their stocks, and then they're looking for what's the best allocation to all these stocks to give us the highest expected return. And they incorporate trading costs because you don't want to just trade, and every time you trade it costs you money. So they incorporate trading costs, but they do it in a way that, you know, they make sure the excess return they're expecting is enough to cover the trading costs and add value to the portfolio. So, you know, you might have interest at one time starting your own firm. And if you want to do that, that's certainly possible. I have a friend in New York who started his own hedge fund, but it's not easy. You probably have to work in business for 10 years or so, or no one's going to invest with you, and you better be saving all of your money. You better keep it cheap, all of your life cheap. Save up several $100,000, if not $1 million. Because what he had to do was when he quit his job, he was at UTSA, he quit his job, started a hedge fund. He had to invest his own money for a few years, build up a track record, and then once he hit about 3 years, he didn't have to do any advertising because all of his data was in the consulting databases, and so they started recommending his fund to their clients. And so he only had 3 employees in his entire firm, one other portfolio manager and an IT person, and that's all they did. You know, their biggest expense was their rent. I mean, other than the salaries, and it was a good fund. He's shut it down since then because his partner was having some issues where she needed to stop. So he just shut it down. Now he's working for another firm and doing great. But yeah, you can do it. It's possible, but you better think now. Your most important thing you got to do, you got to network. You better have a lot of friends because they're the ones that are going to invest with you. In fact, this guy, this friend of mine in New York, he said his most important network were the friends he made in college. Those are the people he was drawing on and advertising, make sure they knew the fund was out there. And then you better save your money because if you're going to start your own fund, you're going to be going without a salary for several years and have to live off your own money. All right, we're going to do efficient frontier, but we'll do it later. I'll come back to it. I want to end up with the last thing here, and that's risk. For risk, what we're talking about here mainly is your sell discipline. We talked earlier in the class about how even professional portfolio managers tend to sell their winners too fast and hold on to their losers too long. And so portfolio managers need to have a very rigorous, very disciplined sales discipline that says, hey, if this stock falls 10%, we're selling it. Or when this stock hits its price target, we're selling it. Now, I don't like to sell it when it hits the price target because most firms, they'll just change their price target and they'll never sell. My favorite is comparing a stock to competitor stocks in the same industry, and if it underperforms the other stocks in the industry by more than 5 or 10%, that's when I say, I made a mistake. I thought the stock was going to do well. I bought Walgreens and instead of CVS, and now Walgreens stock is up 3% and CVS stock's up 15%. Obviously, I did, and all these stocks are up 5 to 10 to 15% except for Walgreens. Obviously, I messed up. Let's sell it and just get out. There was something we missed. But a lot of people say, hey, we weren't wrong. We're just early. Keep holding on. Well, our egos will cause us to keep holding on to bad stocks. So let's think about this efficient frontier here. So to do an efficient frontier, I'm just going to do it for 2 assets. I'm going to do bonds. I'm going to do stocks. And to do an efficient frontier, we need to have an expected return and we need an expected risk. If you want to try to keep up with me on this, you can do it. Pause the video. I'm just going to plug in some numbers. Let's see. We think bonds will make 3% because interest rates are so low. And let's say the risk is 5% because interest rates are so low. Bonds are a little more dangerous. And let's say stocks are going to make 7% with the risk of 16%. So there's my assumptions. The last assumption we need is correlation. And so what we want to do here is let's talk about what is our weight in bonds. Well, let's start with 100% in bonds. And let's bring that down by 10%. So 90%, 80%, 70, 60, 50, 40, 30, 20, 10, 0. So we go all the way from 100% down to 0. And then we have our weight in stocks. Well, obviously that's going to be 1 minus the weight in bonds. So if bonds are 100%, stocks are 0%. And we can just copy that across. So from 0 up to 100. So what we want to do is, what is the return of this portfolio? Well, obviously, if we have 100% in bonds, it gets really easy. We just take the expected return on bonds. I'm going to lock that in with the dollar signs, times our weight on bonds, plus the return on stocks, locked in, times the weight in stocks. Obviously, that's going to be 3% because we have everything in bonds. So we copy that across. Obviously, when we get to 100%, we'll have a 7% return. So we go 100% down to 0, 0 up to 100%, and our stock return will just go up as we add more in stocks. Now the question is, what is our risk? Well, the risk is down here. This is the formula, and you should, if you're a finance major, you should know this formula. This is one of the most important formulas in finance. We got 2 assets. You can do this with 3, 4, 5, 6 assets. It doesn't have to just be 2. We should take the weight of A squared. here's our bonds is A, times the risk of A squared, the risk of bonds, plus the weight of B, which is our stocks, squared, times the risk of B squared, plus 2, weight of A, weight of B, risk of A, risk of B, the correlation between A and B, and you take the square root of that. Hopefully you saw that formula in your statistics class. If not, just memorize it. It's an extremely important formula. So I'm going to put that right here, pretty easy. So we take the weight of A squared times the expected, sorry, I didn't do that right. The weight of A squared, I don't need to lock that in, weight of A squared times the risk of A squared, that you do need to lock in, plus the weight of B squared times the risk of B. Oops, sorry, I got sticky keys here. Plus 2 times the weight of A times the weight of B times the risk of A locked in times the risk of B locked in times the correlation. I'm going to put correlation here. Obviously this should come out at 5% unless I made a mistake. It looks like I made a mistake, so let's see what I did. Oh, and the last thing is you got to take the square roots. Take the square root of that, gives you 5%. So let's do a correlation of 1. So let's just double check, make sure I got all the dollar signs in places where I want to lock in. I want to lock in the correlation as well. So if you're doing it exactly as I'm doing it, just hit freeze and you can see this whole formula right there. So there's our risk, and as we increase our stocks, our risk is going to go up, obviously all the way up to 16%. Now let's graph these two things. When you graph this is the efficient frontier, you always put risk first, return second, because you're going to do an XY graph. So when we do an XY graph, I'm going to move this to its own chart. Efficient frontier. And you notice I'm going to change our axis a little bit. Change it to a minimum is 4%. Oops, not 4. Minimum of 3. So you notice when correlation is 1, you just get a straight line. Not that exciting. What that means is diversification doesn't help you. You add more risk, your return goes up proportionally, your risk goes up proportionally. There's no diversification benefit. Now what if your correlation is 0? What happens to this chart? First thing you notice is your risk actually declines. So that means you would never want to have less than 10% in your portfolio, because a 10% allocation of stocks is less risky than a 0%, even though the return's higher. Now when we look at the efficient frontier, it actually looks like an efficient frontier. It's got that distinctive curvature to it. So there's your efficient frontier. And what this is telling you is your optimal point, but you would never go below here, like right here, or right here, you have higher return, but less risk. A risk is down here. This is your risk at the bottom. Here's your return. So your return is right here, but your risk is here. So you have a higher return than this first point, but less risk. As you go up, that's the efficient frontier. What if your correlation is -1? Then you get a very interesting looking chart. It looks like a V. And there's actually a portfolio somewhere in here that is 0 risk. I didn't put that particular point in there, and I don't know if I can get exactly that point. But there is a portfolio somewhere in here that is exactly 0 risk. You would assume that would be the risk-free rate if you hit there, but if it wasn't, if you could get a 0 risk portfolio and make more than the risk-free rate, you should put a ton of money into it. That would be if you really believe your assumptions. So there you notice that risk just drops dramatically, and then it starts coming back up. So what's the correlation between stocks and bonds? 0 is a pretty typical assumption to make, and that's when you get this transaction. Now, we could add other asset classes. Remember, there's large cap, small cap, value, growth, gold, commodities, high yield bonds, non-US stocks, non-US emerging market stocks. We could add all of those. The question is, where was that straight line? When we did the 1, correlation of 1, where is that straight line versus the curved line? And what the curved line did, when your correlation drops, this line starts shifting left. At every point of return, you can reduce your risk because of diversification. And so that curved line will actually be going just like this. So obviously, and I'll show you, I think you'll see it when I do it. So you're noticing it just shifting out. In fact, it won't let me copy it, I don't think. Maybe it will, let's see. It's kind of a big, a bit too large here. So let's shrink it down a little bit. All right, so what I'm going to do, just so we can see it. So if you watch, let's start at a correlation of 1, the straight line. Then we go 0.9. Just watch it slowly move over to the right. So that's what diversification does for you. At any return, diversification will reduce your risk. And so obviously the straight lines here, you have the exact same returns, but you're moving to the left, which means you have less risk because risk is down here. And that's the idea behind an efficient frontier. The question is where you came up with your assumptions. How confident are you that correlation is 0 or -1? Usually for stocks and bonds, I use a correlation of 0. The problem with that is stocks and bonds are usually negatively correlated, except in a year like the 70s and 80s when inflation is the focus of markets. When inflation is the focus of markets, stocks and bonds move together. So in the 70s, we had high inflation, and both stocks and bonds did terribly. In the 80s, we had inflation falling, and everybody was focused on inflation coming down, and stocks and bonds both did great in that decade. So correlations vary over time, and if you don't think we're going to have an inflation anytime soon, then yeah, stocks and bonds will give you good diversification. We talked about this in my risk management class. I talk about something I'll call environments, which is a new way of thinking about this. Rather than thinking that stocks and bonds have a stable, constant correlation, think about their correlation changes depending on the environment. Are we looking at global risk like we have right now with COVID-19? In that case, stocks and bonds go in opposite directions. Are we looking at a strong growth economy? In that case, bonds don't do well, but stocks do great. Are we worried about inflation? If we're worried about inflation, both stocks and bonds would sell off. So if you use a low correlation between stocks and bonds of, say, 0, yeah, you're going to get great diversification. You're really reducing your risk quite significantly, but you're also assuming inflation will not be an issue for markets anytime soon. Otherwise, you wouldn't use that assumption. All right, so there's the strategy for how to put the portfolio together using optimization. If we had more time, I would show you some strategies. Let me just real quickly show you a few. So these are just some strategies I collected over my time. Here's a firm. I think this is called Mar Capital or something. I forget the name of the company. But they said they have 4 criteria. Grow shareholder value. They have a wide moat. Economic moats is a big issue that you want firms that are profitable and they can maintain that profitability without competitors coming in. Good management team, and the stock is mispriced. So that's what they use. And they have a process. There's their process. You can see they start with 500 stocks, screen down to 150, screen down to 50 to 60, and then their final portfolio. So this is the universe. These are the good companies. These are the good stocks. And then the final one is their final selection. And then they have sell discipline over here. So just like I was talking about, here's another process, Turner Investments. Step 1, proprietary quantitative model. We talked about that in our class. You use that term. They have 72 factors. So this is a really quantitative firm. They say they have no biases. That's never true, but they say it anyway. You can look at kind of things they look at: low PEs, low EV to EBITDA, low price to book, low debt to capital ratio, So they have criteria. Again, it's their philosophy. What kind of stocks will outperform the market? Here's another firm. So you can just see, you'll generally, and there's a quantitative model right there. You'll frequently see, let me see if I can show you one. You'll frequently see kind of a process going from top to bottom, or you'll see the, probably the most popular is the pyramid type of thing. You start with the universe, and then you come down to your portfolio at the end. So, you know, what I encourage you to do, you can find these out online anywhere. Just go to investment firms and just institutional investment processes and just look at some of these and just grab what you like and create your own philosophy and write it out. So when you get into an interview, you can intelligently talk about how you would put a portfolio together. You do not want to interview with an investment firm without having at least thought about that. All right, that's it for today. Next class, we'll get into my favorite topic, which is derivatives, and then we'll be really ready to get into the end of the semester and get ready for the final.